The top 5 reasons for a stock market crash in 2020. On YouTube and Twitter Finance, there's a lot of talk about an incoming stock market crash that will be historic, something comparable to the Great Depression. I came across multiple videos referencing some of these reasons, and they seem legitimate, well-researched points. In this video, I wanted to analyze the top 5 reasons and really look into what they're saying in detail and relate it back to you, understanding what decisions you can make to profit off these predictions that are sure to dominate the news cycle in the upcoming year. Number 1. Share buybacks. According to many, the so-called corporate share buyback Ponzi scheme has come to an end as public pension funds with billions and billions of dollars are now in trouble with no tax revenues to buy corporate bond issuance to fund corporations who use this very money to buy up and drive their own stock price to stuff management pockets. While this theory is interesting, it's not really the full picture. According to JP Morgan, buybacks are expected to plunge 50% in 2020. But if we look at a historical chart, it's expected that these new 2020 levels will be right around what they were in 2012, 2013, 2014, and 2015. So in reality, it won't be that bad according to current positive expectations. Buybacks will forever be controversial, and without a doubt they will continue to be used in the finance world to artificially drive up stock prices. As a percentage of profits, we can see this from this chart. The reality of the situation is different. On average, a company in the S&P 500 uses about 28% of its profits to buy up stock. This is actually lower than in years past, and while the overall volume has been high in recent years, this is not unusual. We saw the same in the early 2000s, and as we stated earlier, buybacks slowing down is not an indicator of a clear recession or depression. There are plenty of things that play into this cycle, and over the coming years, they could be right back to where they were. Although they will forever remain a sore point in the investing world, share buybacks are not going to cause the downfall of the American economy. We move on to number 2, low economic growth. If we take a look at the average world growth rates in the economy for over the past decade, it's barely growing at 1% despite all the quantitative easing by banks around the world. Interest rates are pushing 0, sometimes even going past 0 into the negative territory. In simple terms, this theory is simply not true. The world has been growing with 3% average GDP growth for well over a decade, and this has put us in a good relative spot to the rest of human history, where we can see that GDP moved along at an incredibly slow pace for multiple years, decades, and even centuries. We then move on to number 3, my favorite. Berkshire Hathaway is selling stock, and because they're doing so, it's an indication that the economy is in the gutters. It sold $8.6 billion of equity and only bought $4.4 billion in 2020. This must be a sign that something is off and the market is ready to crash. After all, this is Warren Buffett we're talking about. This theory could not be further from the truth, and Warren Buffett has spent years and years repeatedly answering this question himself, so I'll let him do it here again so that you can have his word for it.
You said just a few minutes ago when we asked you on Worldwide Exchange, right now Berkshire Hathaway is a net buyer of stocks. You are in a net buying position?
We've been a net buyer of stocks, or I've actually been a personal net buyer of stocks ever since I was 11, every year. There's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them. Now, I haven't bought stocks every day. There have been a few times I thought stocks were really quite high. And I've even written an article once or twice, but that's very seldom.
But you wrapped up your partnership at one point,
I wrapped up my partnership once.
Because you thought it was too expensive.
Yeah.
Word for it. We now move on to number 4, a concern that 5 stocks represent 25% of the S&P 500 and 40% of the NASDAQ. These percentages are alarming. If we look at a more detailed breakdown, Facebook, Amazon, Apple, Microsoft, and Google are up 11% on the year, while the rest of the 495 stocks that make up the S&P 500 are down 15% on the year. We basically have 2 different. What is going on? There is a simple explanation to this. That is basic investment. You have a few winners that carry the rest of the team. If we look at those 5 companies individually, you can see why they carry the S&P 500. We use Amazon, Apple, Facebook, Google, and Microsoft daily. These are companies that are dominating the landscape and deserve essentially all the profits and evaluations they receive. Just use this video as an example of the sheer dominance these companies have on the American public. I'm uploading this video with an Apple laptop to a Google server. You might be watching it on a Microsoft laptop and sharing it to Facebook. That's a clear indication that these companies are dominating the business landscape in the United States. And finally, we have number 5, market pundits. There's always media hype behind predicting doom. You have to be careful when listening to the media, especially in today's day and age. Just as Warren Buffett has stated, there's always going to be trouble coming. He's lived through a lot. Any person of his age has seen many things. For an example, in 1942, when he bought his first stock, all kinds of trouble was brewing. America had lost the territory of the Philippines. Germany had begun its attack on the world, and it looked like evil was beginning to conquer the earth. Thank you guys for watching. Make sure you hit that subscribe button if you enjoyed, and leave a comment if you disagree or agree with any of the points I've made throughout the video.